Hello, my awesome accounting students. Welcome back to another chapter on payroll. This time we'll be looking at payroll taxes that employers pay. In the previous chapter, we focused on the taxes that you and I as employees pay. So let's get started. There are four major taxes that employers pay. Two of them are matching and are taxes that we already covered, and two of them are unique to the employer only. That means you and I don't have them withheld. As you will recall from Sam's gross pay in the previous video, he paid into Social Security 6.2% of his gross wages, and he paid through his own withholdings Medicare at the rate of 1.45%. These two amounts together are called FICA, which stands for the Federal Insurance Contributions Act. The employer has to kick in matching shares. The employer in this case would have to match the $35.03 of Social Security and the $8.19 of Medicare. Unemployment taxes are levied on the employer only. That means you and I do not contribute towards that. Unemployment taxes are meant to subsidize employees that are between jobs. You can read more about the unemployment taxes in the text. The federal unemployment is assumed to be 0.6% or 0.006 on your calculator. State rates vary widely. The federal government expects the states to bear the burden of their unemployed citizens. So in the book, we'll be using a state unemployment rate for California of 5.4%. Just know that no matter which state you live in, the threshold for the maximum is fairly low. Typically, it's $7,000 in wages per employee. So what this means is employers bear the brunt of the unemployment tax burden in the earlier part of the year. Once an employee reaches the $7,000 threshold, the employer no longer has to pay unemployment taxes on that employee. Assuming that Sam had not maxed out and had not yet made $7,000 this year, the employer's FUTA tax would be calculated by taking the gross pay of $565 times the FUTA rate of 0.006. This equates to $3.39. SUTA, on the other hand, will be much higher. Remember, the federal government expects the states to take care of their own. For the SUTA tax, if we assume a rate of 5.4%, then the SUTA tax would be the gross pay of $565 times the rate of 5.4% or 0.054. On the screen is a recap of the four employer taxes that we just computed. The matching taxes of Social Security and Medicare are shown first, and the employer taxes for federal and state unemployment are shown second. Let's take a look at the journal entry to record these. Payroll tax expense is debited for the total amount of the four taxes, in this case $77.12. Each one of the four employer payroll taxes are credited for the appropriate amount. Take a moment to study this journal entry as it is the main one in Chapter 11. Payments of federal taxes are paid every so often. I don't want you worrying about how long a company has to make the payments or whether there's a look back or look forward period. All I want you to understand is that when payroll taxes are deposited, the liability goes away with a debit, and of course the cash would be credited. So take a look at who deposits payroll taxes and work on the general journal entry to do that. There are a barrage of forms in this chapter. Don't worry, I won't ask you to complete any of them, but I do expect you to understand what the basic forms are. Here is a Form 940 that is used to submit the federal unemployment. Then there's the 941 that is used to remit the employer's quarterly federal tax return. Take a short look at this one because it is used by small businesses. The Form W-2 is something we all get at the end of the year from our employers. It tells us how much wages we have made and the various taxes that have been withheld on our behalf. The next statement is a Form W-3, and it's called the transmittal of wage and tax statements. Visually picture all of you in my class as my employees. I would fill out a W-3 that would summarize or add up all of your individual W-2s. I put the W-3 on the top of the package and then submit it to the various taxing authorities. The last topic is something that we mentioned in the previous chapter. Workers' comp is more of an insurance than it is a tax. In this case, the Tomlin Furniture Company has two categories of work classifications. The office workers premium is a lot cheaper than the shipping workers premium. So take a look at those premiums and let's look at the journal entries required to properly record workers' comp. Based on the company's payroll records, they estimate their total premium to be $1,000. You'll notice that the initial payment of the premium is recorded as a prepaid. Then, at the end of the year, when the actual wages are known, the auditor comes in, compares the estimated wages to the actual wages, and makes an adjustment for the difference. Sometimes the company may owe a little bit more, sometimes they may get a refund. In this case, the company owes a little bit more. $261.20 will be the balance of the premium due. Here's a quick glance at the adjustment. In addition, all of the old workers' comp prepaid account needs to be written down to zero since the year is over. Your author ends the chapter with taking a look at internal controls over payroll. Take a moment to freeze the slide and review the various controls. In a nutshell, it is always important to maintain controls over payroll. This is Professor Johnson signing out.